You know the exact environment.
Oh, I think we all do.
Yeah, it's that oppressive silence of an exam hall. It's broken only by the sound of like 100 MBA students frantically scribbling.
Just sweating over the test paper.
Exactly. Staring at some horribly complex corporate finance formula and, second guessing whether a specific market shock is systematic or unsystematic risk.
It is a terrifying place to be if you aren't prepared.
It really is. So if you are listening to this right now, you are likely in the trenches of your MBA studies. Specifically, you're staring down the syllabus for Unit 6 of Corporate Finance, which is a risk and return, an overview.
Right.
You've got the textbook open, the lecture notes are just scattered everywhere, and you are trying to synthesize a massive amount of quantitative theory.
And that's exactly why we're doing this deep dive today.
Yes. Our mission today is to take that specific source material and, well, reconstruct it so deeply that you won't actually need to memorize anything.
Which is really the only way to truly survive an advanced finance exam. I mean, rote memorization just fails under the pressure of a timed test.
Yeah.
Especially when professors, and they invariably do this, they tweak the variables to see if you actually understand the underlying mechanics.
Oh, they love doing that. They change one little thing.
They really do. But the overarching theme of your Unit 6 material, and frankly, the foundational premise of all modern financial theory, is this inescapable trade-off between risk and return.
Right.
Every single formula in this chapter is simply an attempt to put a mathematical value on human uncertainty.
Uncertainty is definitely the operative word there. So let's dig right into the core motivator of this entire ecosystem, and that is, of course, return.
The reason we do all of this.
Exactly. The textbook divides return into two distinct temporal concepts, right? Realized return and expected return.
Yes, the past and the future.
Right. So realized return is the postmortem. It's the historical data, the capital that has already, cleared the bank.
It happened. It's done.
Exactly. While expected return is the projection. It is the weighted probability of what you anticipate earning over some future holding period.
Right, looking forward.
But regardless of whether we are looking backward at the data or forward into the fog, the source insists that we break the composition of return into two distinct components.
And this is a critical distinction, honestly. It's a place where even seasoned investors can develop blind spots, let alone MBA students under pressure.
Sure.
The text categorizes these as current return and capital return.
Okay, let's unpack this for the exam. To ground this, let's step away from abstract securities for a minute. Imagine you're executing a private equity buyout of a B2B software as a service company.
A sauce business.
Okay.
I like that.
Yeah.
Much more relevant scenario for an MBA than, buying an apple orchard or something.
Right, exactly. We want a real-world proxy. So, when you acquire that sauce business, your total return over the next 5 years is going to come from two completely separate streams.
Two streams, right.
The first stream is the current return. In the context of your sauce business, this is the free cash flow generated by the annual recurring revenue.
The money coming in every month.
Yeah. The business operates, it pays its expenses, and it distributes cash to you, the owner.
Right. And in the public markets, to map it to the textbook, this is your dividend yield on an equity or your coupon payment on a corporate bond.
Exactly. It's the periodic income generated simply by holding the asset. And it's measured relative to the price you paid to acquire it.
But the cash flow is only half the thesis, right?
Yep. The second stream is the capital return. So say you bought that sauce company for $50 million.
Okay, 50 million in.
Over 5 years, perhaps the broader market tech multiples expand, or you dramatically improve the underlying margins, and then you exit the investment by selling the company for $80 million.
A nice $30 million profit.
Exactly. That $30 million difference is your capital return. It is the price appreciation of the underlying asset itself.
And this right here is where students often lose points on the exam.
Oh, really? How so?
Well, they'll focus heavily on like a high-growth tech stock that pays absolutely zero current return, no dividends at all, and they calculate only the capital appreciation.
Ah.
Or, conversely, they'll analyze a government bond and hyper-focus on the interest payments while completely ignoring the fact that the underlying price of the bond has depreciated in the secondary market.
So they're only looking at one half of the equation.
Exactly. The textbook is extremely rigid on this point.
Yeah.
Total return is unequivocally the sum of both the cash flows generated plus the change in the asset's capital value.
Okay, so let's translate that framework into the actual formula you will need to execute on the test.
Let's do the math.
The historical return formula for a single security is written as, and write this down, Total return equals the cash payment received plus the difference between the ending price and the beginning price.
Right, the cash plus the capital gain.
Exactly. And then you take that entire sum and you divide it by the beginning price.
Let's apply that to the source material's specific problem regarding the investor, RAM.
Good old RAM.
Right, standard textbook example. He purchases shares at a beginning price of 10 rupees.
Okay, PB is 10.
During the holding period, he receives a dividend, which is the cash component, of 2 rupees.
Got it. C is 2.
He then liquidates the position at an ending price of 13 rupees.
Okay, PE is 13.
So the arithmetic is really straightforward. A 3 rupee capital gain plus a 2 rupee cash dividend yields a 5 rupee total gain.
The mechanical trap here, though, is in the final step. Converting that raw currency gain into a percentage.
Yes.
I have seen students instinctively take that 5 rupee gain and divide it by the ending price of 13 rupees.
Which is mathematically useless. It tells you nothing.
Right.
The denominator in your return calculation must always, without exception, be the beginning price.
Why is that so crucial to remember?
Think about the economic reality of the transaction. You are trying to measure the efficiency of your deployed capital.
Yeah.
RAM sacrificed 10 rupees of purchasing power to enter this trade.
Right.
That specific 10 rupee sacrifice generated 5 rupees of brand new wealth. Therefore, the efficiency of his initial capital is 5 divided by 10, which yields a 50% total return.
That makes perfect sense.
Dividing by the exit price of 13 tells you absolutely nothing about the performance of your initial investment. It's a classic distractor on multiple choice questions.
So always divide by PB. Got it. Now that covers the historical, realized reality. But corporate finance is fundamentally forward-looking.
It's all about what happens next.
Right. We have to estimate expected return, which the text models using probability distributions. We are no longer dealing with known variables here. We are dealing with scenarios.
And the statistical tool for dealing with scenarios is the weighted average.
Okay, break that down for us.
The formula dictates that you take the predicted return for a specific economic state and you multiply it by the probability of that state actually occurring.
The syllabus uses the ABC limited example for this. Let's walk through it.
Sure.
We have 3 projected macroeconomic environments next year. Good, average, and poor.
Pretty standard modeling.
Yep. In a good economy, our models predict a 20% return for the security. In an average economy, a 15% return. And in a poor economy, a negative 4% return.
Right, a standard spread of outcomes. But to find the expected return, we need the probability weights for those environments.
Which the textbook provides.
Exactly. The source assigns a 30% likelihood to the good state, a 50% likelihood to the average state, and a 20% likelihood to the poor state.
And where do these probabilities even come from in the real world?
In actual financial modeling, these probabilities are often derived from really complex macroeconomic forecasts, Monte Carlo simulations, or historical base rates.
Right, heavy quantitative stuff.
But for the exam, they're simply given to you. And, importantly, they must always sum to exactly 100%.
Okay, so the execution is just a series of products and a final sum. Let's do it.
Let's do the math.
The good state's 20% return, weighted by its 30% probability, contributes 6% to the total expectation.
Right.
0.3 times 0.2.
Correct.
Then the average state's 15% return, weighted by 50%, contributes 7.5%.
0.5 times 0.15, yes.
And finally, the poor state's negative 4% return, weighted by 20%, drags the expectation down by 0.8%.
Right. 0.2 times negative 0.04.
So summing those weighted contributions, 6 plus 7.5 minus 0.8 gives us an expected return of 12.7%.
Perfect. But I want to pause on that 12.7% figure for a second.
Why? Did we mess up the math?
No, the math is flawless.
Yeah.
But there is a huge conceptual hurdle here. You do not actually expect to earn 12.7%.
Wait, what?
Think about it. If the year plays out, you will experience either a good, average, or poor state.
Okay.
Meaning you will likely earn 20%, 15%, or negative 4%. You will almost certainly not earn exactly 12.7%.
Okay, so then what is the utility of the 12.7% metric if it's basically a financial fiction?
Because it is the mathematical center of gravity for your risk models. It's the singular probability-adjusted number you must use today to compare this asset against a totally different asset.
Ah, I see.
Yeah, say you have another asset with 10 possible future states. You need a way to compare them. It reduces the absolute chaos of probability into a single comparative metric that you can use to actually price the asset today.
That makes a ton of sense for pricing. But, the source material introduces a massive caveat to all these return
The
calculations.
inflation caveat.
Exactly. And professors love to test this because it bridges finance with macroeconomics. It's the distinction between nominal returns and real return.
It is so crucial.
Everything we've discussed so far, REM's 50% historical gain, ABC Limited's 12.7% expected return, those are nominal.
Right, they just represent raw currency expansion,
But they completely ignore inflation.
which means they ignore the entire underlying purpose of investing in the first place.
Right.
We invest to defer consumption today in exchange for greater purchasing power tomorrow. If your nominal portfolio grows by 10%, but the cost of your standard of living increases by 6%, your actual wealth, your ability to consume goods and services, did not grow by 10%.
You actually lost ground relative to your goal.
Exactly.
So the formula provided to calculate this real return is 1 plus the nominal rate divided by 1 plus the inflation rate, and then you subtract 1 from that result.
Mechanically, it's just a ratio.
But let's look under the hood of that ratio. Why are we adding 1 to these percentages before dividing? Why not just divide 10 by 6?
Because you are dividing index values of purchasing power, not just the raw growth rates. The 1 represents your initial capital block.
Right.
Your 100%. Okay, track with me here.
If you start with 100 units of purchasing power, a 10% nominal return means your account now holds 110 units.
Right, so that is the numerator, 1.10.
Exactly. However, the price of the economic basket you wish to purchase has also expanded. At 6% inflation, what used to cost 100 units now costs 106 units.
So that is the denominator, 1.06.
You've got it. So you take your expanded nominal wealth of 1.10 and divide it by the new expanded cost of living, 1.06.
And doing that division yields approximately 1.0377.
Right. Then you subtract the initial capital block back out of the equation, and you isolate the real growth rate.
Which is 0.0377 or 3.77%.
Exactly. Your brokerage account is going to tell you that you made 10%. You feel great. But the economic reality is that you are only 3.77% wealthier.
That is a brutal reality check. It is. And in an exam context, if a question provides both a nominal return and an inflation rate, underline them both, you are almost certainly being tested on your ability to deploy this specific purchasing power ratio. Don't just subtract 6 from 10.
That's a great tip. All right, let's pivot to the other side of the ledger. We have defined the reward. Now we have to define the toll the market extracts to grant that reward.
Time to talk about fear.
Yes, we have to conceptualize risk. And the MBA definition of risk is fundamentally different from the layman's definition.
Very different.
To the average person, risk simply means the probability of losing money.
Now look, the possibility of losing your initial principal is absolutely a component of risk. Nobody wants to lose money.
Right.
But the textbook definition is far broader. In corporate finance, risk is defined as the chance that an investment's actual return will be different than expected.
Different than expected.
Yes. The operative concept here is variability or volatility.
Which means, from a purely statistical standpoint, upside surprises are technically classified as risk.
Yes, they are.
Which sounds crazy. If I project a 10% return and the asset actually delivers a 40% return, my client is thrilled. But my risk model categorizes that asset as highly volatile and therefore highly risky.
It sounds counterintuitive, but from an institutional perspective, that upside volatility is a massive problem.
Explain that. Why is making more money a problem?
Imagine you are managing a massive pension fund. You have calculated precisely that you need an 8% annualized return to meet your future cash liabilities to retirees.
Okay, you have a strict target.
You model a portfolio to hit that exact target. If the portfolio suddenly swings to 40%, it means the underlying assets are wild and unpredictable.
Oh, I see where you're going.
Right. If they can swing up to 40% this year, they can easily swing down to negative 20% next year.
Leaving you completely unable to pay pensions.
Exactly. Unpredictability in either direction is the enemy of financial planning. Hence, variability is risk.
That makes total sense. And not all variability is generated by the same forces, which brings us to a massive portion of the syllabus, The risk taxonomy.
This is pure exam territory, right?
Oh, absolutely. The source material divides the entire universe of risk into two mutually exclusive categories: systematic risk and unsystematic risk. Let's start with systematic risk.
Okay, so systematic risk is essentially macro-level non-diversifiable risk.
Meaning you can't hide from it.
You really can't. It is the bedrock volatility inherent in the entire economic system. It affects all firms, regardless of their individual operational excellence.
So even a perfectly run company feels it.
Absolutely. You cannot build a stock portfolio diverse enough to insulate yourself from it because all publicly traded securities have an underlying covariance.
Yeah.
They tend to move together in response to massive systemic shocks.
Okay, let's use a real-world proxy to dissect the three components of systematic risk listed in the text. Look at the global market environment around 2022.
Oh, a perfect example.
The first component is simply market risk. This is the tendency of securities to move with the broader market cycle, driven by macroeconomic outlooks and just broad investor psychology.
Right.
In 2022, as fears of a global recession mounted, virtually the entire S&P 500 contracted. It didn't matter if a specific software company had record earnings, the broad market psychology dragged its valuation multiple down.
That is pure market risk. The tide goes out and all boats drop. You can't outmanage market panic.
What about the second component?
The second component of systematic risk is also deeply tied to that 2022 timeline. It's interest rate risk.
Oh, boy.
And this is perhaps one of the most critical mechanical relationships an MBA student absolutely must understand for the exam: the inverse relationship between interest rates and existing bond prices.
Let's really break that mechanic down because I know it's super counterintuitive for beginners.
It definitely is.
Why does a central bank raising interest rates obliterate the value of bonds that investors already hold in their portfolios?
Okay, think of a bond as a fixed legal contract for a stream of cash flows.
Right.
Suppose you acquire a freshly issued 10-year corporate bond with a face value of $1,000, paying a 5% fixed coupon.
Okay, so I am guaranteed $50 a year.
Exactly. Now, assume inflation spikes and the central bank aggressively hikes the baseline interest rate to try and cool the economy.
Like they did in 2022.
Right. Now, new corporate bonds entering the market must offer a 7% yield just to attract capital.
So those new bonds are paying $70 a year.
Yes.
So my old 5% bond is completely obsolete. I'm holding a contract that pays $50 when the guy sitting next to me can buy a contract for the exact same price that pays $70.
Exactly. The cash flow of your bond is legally fixed. It cannot change. Therefore, the only variable that can change to make your bond competitive in the open market is its price.
Price has to drop.
It has to. If you want to sell your 5% bond to another investor, you must discount the price well below $1,000 until the yield on that discounted price matches the new 7% market rate.
That makes perfect mathematical sense.
This is known as duration risk. As rates rise, the capital value of all existing fixed income securities systematically falls. It's gravity.
Which feeds directly into the third component of systematic risk: purchasing power or inflation risk. This completes the macroeconomic feedback loop.
It really does.
The source notes that investors demand an inflation premium.
They demand it because, as we established earlier with the real return formula, inflation destroys the purchasing power of future cash flows.
Right.
If inflation expectations rise, bondholders demand a higher nominal yield to compensate for that deterioration.
Which forces interest rates up across the board.
Which, as we just established, forces asset prices down. Market risk, interest rate risk, and inflation risk are all deeply intertwined macro forces. They are the systemic weather. You can't escape them.
Okay, so if systematic risk is the macro weather, then unsystematic risk is the structural integrity of a specific house.
That's a great way to put it.
Unsystematic risk is micro-level. It is firm-specific or industry-specific volatility. And crucially, because it is random and isolated, it can be entirely eliminated through portfolio diversification.
Yes, and this is the entire theoretical basis for mutual funds and broad index investing.
Right.
If you hold 30 randomly selected stocks across completely different sectors, the unsystematic risk approaches zero. A localized disaster in one company is statistically offset by an unexpected windfall in another.
Let's look at the two components the textbook lists for unsystematic risk, starting with business risk.
Okay.
This is the variability in a firm's operating income driven by its specific competitive environment. It's the risk that, a new competitor releases a superior product, or your supply chain management fails, or consumer tastes shift away from your brand.
A classic historical example would be Blockbuster Video.
Oh, perfect.
The emergence of streaming technology was a devastating business risk realization for video rental companies. It completely destroyed their operating income.
Right.
But it did not crash the broader stock market. It didn't affect automakers or agricultural firms or banks. It was a highly concentrated, industry-specific micro event.
The second component is financial risk, and this is where the finance department actually creates risk.
Self-inflicted risk.
Exactly. The syllabus defines this as the variability in earnings caused by a firm's degree of leverage, meaning the ratio of debt to equity.
Yes.
So why does funding a company with debt, rather than issuing new stock, drastically increase the volatility of returns for the shareholders?
Because debt acts as a mechanical amplifier. When a company issues equity, it owes no fixed payments. If revenues drop by 10%, the profits drop, and the shareholders just have to accept a lower dividend.
It's painful, but the company survives.
Right. Debt, however, introduces a rigid, unforgiving legal obligation. Fixed interest payments.
The interest must be paid regardless of the revenue line.
Correct. Imagine a highly leveraged firm operating on really thin margins. If a minor economic hiccup causes a 10% drop in revenue, the operating income shrinks. But that massive fixed interest payment remains identical.
Ouch.
It acts like a guillotine, just chopping off the entirety of the remaining profit before it can ever reach the equity shareholders.
Wow.
So a small fluctuation in operating income translates into a massive, volatile swing in earnings per share. High leverage magnifies both gains on the upside and destruction on the downside. That is financial risk. And it is entirely unique to the specific capital structure chosen by the firm's management.
Okay, let's do a quick rapid-fire synthesis to make sure this taxonomy is locked in for an exam scenario.
Let's do it.
I'll throw out a market event. We classify it based on the textbook's rules. Scenario 1. A global shortage of semiconductor chips disrupts production for auto manufacturers.
Unsystematic. It is a severe business risk, definitely, but it is isolated primarily to the tech, hardware, and automotive sectors. A diversified portfolio holding healthcare, financials, and consumer staples would be largely insulated from that specific shock.
Perfect. Scenario 2. The Federal Reserve unexpectedly cuts the prime interest rate by 50 basis points.
Systematic. That is pure interest rate risk.
Because it hits everything.
Exactly. It alters the discount rate used to value every single cash-flowing asset in the entire economy, immediately impacting the price of all bonds and equities simultaneously.
Fantastic. So we understand the taxonomy of volatility now, but a qualitative understanding isn't enough for an MBA exam. We have to quantify it.
Time for the math.
We need the mathematical tools to measure just how wild these fluctuations actually are. Let's move to measuring single security risk.
The standard statistical tools the syllabus employs to measure this variability from the mean are variance and its square root standard deviation.
Right.
The standard deviation effectively tells you, on average, how far the actual historical or expected returns drift away from the central average return.
I want to tackle a specific metric the textbook introduces before we do the heavy variance math. It's the coefficient of variation, or CV.
Oh, a classic trick question topic.
Exactly. The formula is standard deviation divided by expected return. I can easily see a professor using this to trick students into choosing the wrong investment.
Oh, but do it every year.
Why is standard deviation alone insufficient when you're comparing two totally different assets?
Because absolute standard deviation lacks context. Consider a hypothetical exam question. Asset A has a standard deviation of 5%. Asset B has a standard deviation of 15%. Which asset is riskier?
Well, the instinct is to say asset B, obviously, because 15 is higher than 5. It has 3 times the absolute volatility.
And that is exactly the trap. You must look at the denominator of the expected return. What if asset A only expects a 2% return, while asset B expects a 30% return?
Yeah.
Asset A's 5% volatility is actually massive relative to its tiny 2% expected gain. But asset B's 15% volatility is quite manageable given its massive 30% expected return.
So the coefficient of variation standardizes this relationship. For asset A, 5 divided by 2 equals a CV of 2.5.
Right?
For asset B, 15 divided by 30 equals a CV of 0.5.
Exactly. The CV measures the units of risk you are absorbing per single unit of expected return.
That's a great way to phrase it.
Asset A requires you to stomach 2.5 units of volatility just to get 1 unit of return.
Right.
It is a terrible risk-adjusted investment.
Right.
Asset B only requires 0.5 units of volatility per unit of return. The CV provides a level playing field, proving that Asset B is fundamentally less risky on a relative basis, despite its higher absolute standard deviation.
That is a phenomenal exam insight. Okay, now let's roll up our sleeves and look at the actual calculation for variance, starting with historical data.
Let's get into the weeds.
We're working with the alpha limited example from the text. We have 5 years of historical returns. 15%, 20%, 10%, 10%, and 5%.
Okay.
The prerequisite step is to find the arithmetic mean.
Right, so summing those 5 percentages gives us 60% divided by 5 years, yielding a mean return of 12%.
Wait, hold on. Let me look at the source materials data table here.
Go for it.
The textbook actually calculates the arithmetic mean, they call it R bar, as 10%. Let's look closely at their table. I see it. There is a typo in the original textbook's provided dataset.
A typo in the textbook.
Yes. They list the returns in decimal form in the table, 0.15, 0.20, but then they list 2004 and 2005 as 0.01 instead of 0.10.
Oh, wow.
And 2006 is listed as 0.5 instead of 0.05.
Well, this is a rite of passage for MBA students, honestly, finding the mathematical errors in the assigned reading.
It really is.
If we look at the summation row at the very bottom of their table, they calculate the sum of the returns, sigma rho, as 0.50.
Right.
Dividing that 0.50 by 5 years gives the 0.10, or 10%, mean that they use for the rest of the calculation.
So we have to use their flawed 10% mean to replicate their variance steps accurately.
Exactly. We must follow their 10% mean if we want our variance to match the book's answer.
Understood. Okay, using their 10% mean, the next step is to find the deviation for each specific year by subtracting that mean from the actual return.
Right.
For 2002, the return was 15%. We subtract the 10% mean, giving a positive deviation of 0.05.
Got it.
For 2003, 20% minus 10% gives a positive deviation of 0.10.
And in 2004 and 2005, the returns matched the mean exactly at 10%, resulting in a deviation of 0.
Easy enough.
And in 2006, the return dropped to 5%. Subtracting the 10% mean results in a negative deviation of 0.05.
Now, this is where the statistics require an intervention.
Yes, they do.
If we simply summed up these deviations right now to find total volatility, the positive 0.05 from 2002 and the negative 0.05 from 2006 would just cancel each other out.
Right. They would sum to 0, which artificially implies 0 volatility, which is obviously false.
Which is why the formula dictates that we squared each individual deviation before summing them.
Exactly.
Squaring a negative number mathematically forces it to become positive, preserving the magnitude of the volatility regardless of its direction. But squaring achieves a second, deeper philosophical goal in risk management too, doesn't it? It disproportionately penalizes large outliers.
It absolutely does. And this is vital. Think about the real-world impact of volatility on compounding capital. A series of small deviations from the mean is annoying, sure, but it's survivable.
Right.
A single massive deviation, a black swan event, like a 40% market crash, can mathematically destroy a portfolio's ability to ever recover.
Because it wipes out the capital base.
Exactly. By squaring the deviations, a deviation of 2% becomes 0.0004, but a deviation of 10% becomes 0.01.
Wow.
A deviation that is 5 times larger is penalized 25 times more heavily in the variance calculation. The math literally forces the model to respect the destructive power of fat tail risks.
That is a brilliant way to conceptualize it. Let's execute the squaring for alpha limited.
Okay, crunch the numbers.
The 0.05 deviation squared is 0.0025. The 0.10 deviation squared is 0.01. The zeros remain 0. The negative 0.05 squared becomes a positive 0.0025.
Right.
We sum those squared deviations, 0.0025 plus 0.01 plus 0.0025 to arrive at a total sum of 0.015.
Now comes a critical divergence in the formula that will undoubtedly appear on your exam. Pay attention to this.
What is it?
To find the final variance, we must divide that sum. But we do not divide by n, the number of years. The historical variance formula requires us to divide by n minus 1.
Oh, right.
In this case, 5 years minus 1, meaning we divide by 4.
I always hated this step in statistics. Why introduce the -1? If we have 5 years of data, why are we pretending we only have 4? It feels arbitrary.
It's not arbitrary at all. It is a statistical principle known as Bessel's correction, and it deals with sample bias.
Sample bias, okay.
We are calculating the variance of a tiny 5-year sample of alpha-limited's historical returns, right? Not the entire population of all possible returns the company will ever generate.
True, it's just a snapshot.
In small samples, the data points tend to cluster closer to their own specific sample mean than they would to the true unknown mean of the entire population over decades.
So if we just divide by n, we are artificially underestimating the true underlying volatility of the asset.
Exactly. Dividing by n produces a variance that is structurally too small, which is incredibly dangerous in risk management. By shrinking the denominator to n minus 1, dividing by 4 instead of 5, we mathematically inflate the resulting variance.
It's a buffer.
Yes, it is a conservative correction factor to ensure we aren't underestimating the risk based on a limited data set.
Okay, so 0.015 divided by 4 gives us a variance of 0.00375. But variance is expressed in squared percentages, which is conceptually useless to a human being.
Right. You can't tell a client they have squared percent risk.
Exactly. So the final step is to take the square root of the variance to return the metric to the original unit's standard percentages.
The square root of 0.00375 is roughly 0.0612 or 6.12%.
Nice.
That is Alpha Limited's historical standard deviation. Over that 5-year period, the annual returns deviated from the 10% mean by an average of 6.12%.
All right, that covers historical risk. But the exam will also test your ability to calculate expected risk using probabilities.
Right. Looking forward again.
We return to the Axis Bank example with our good, average, and poor states. 30% chance of a 20% return, 50% chance of a 15% return, 20% chance of a -4% return.
We already did this part.
Right. We previously calculated the expected return, the weighted mean, at 12.7%.
The initial steps for risk are identical to the historical method. Find the deviation by subtracting the mean from each state's return.
Okay.
For the good state, 20% minus 12.7% is a deviation of 0.073. For the average state, 15% minus 12.7% is 0.023.
And for the poor state?
For the poor state, -4% minus 12.7% is a massive negative deviation of 0.167.
We square those to eliminate the negatives and penalize the outliers, just like before. Good state squared is roughly 0.0053. Average state squared is roughly 0.0005. Poor state squared is roughly 0.0279.
But here is the critical pivot for the exam. Listen closely. For expected data modeled with probabilities, we do not sum these up and divide by n-1.
We don't.
No. Instead, we multiply each squared deviation by its specific probability weight before summing them.
Why do we abandon Bessel's correction here? We used it 5 minutes ago.
Because we are no longer dealing with a limited historical sample. The probability distribution, which adds up to 100%, represents the entire defined universe of possible future outcomes in our model.
Oh, I see.
There is no unknown population mean to correct for. Furthermore, the probabilities themselves act as the weighting mechanism. Look at the poor state. It has a massive squared deviation of 0.0279, but only has a 20% chance of occurring. If we didn't multiply it by 0.20, we'd be massively overstating its impact on the expected variance.
So we let the probabilities do the heavy lifting. We multiply the good state squared deviation by 0.30, the average by 0.50, and the poor by 0.20.
Exactly.
We sum those 3 weighted results, and the source material gives us a final variance of 0.02174.
The mechanism of the math is actually quite elegant once you see the logic behind it. Square the deviations to respect fat tail risks. Use n-1 to conservatively correct for small historical samples. Use probability weights when modeling the total expected future.
Which brings us to the grand synthesis of the entire chapter. We have mapped out the mechanics of return. We have mapped out the taxonomy and measurement of risk. How do these two forces govern the capital markets?
Golden rule.
The text states the fundamental rule of investment management. The higher the risk, the greater will be the returns.
Now, I have a slight issue with the textbook's phrasing there.
Oh, what's wrong with it?
It should state, the greater will be the expected returns.
Expected.
Yes, if taking higher risk mechanically guaranteed higher actual returns, it wouldn't be risky, it would just be a free lunch.
That is a very good point.
The reality is that the market must promise you the potential for a higher reward to incentivize you to absorb the stomach-churning volatility of higher standard deviations.
To visualize this dynamic, the text provides figure 6.1, the risk and return trade-off curve. Imagine a graph where the horizontal x-axis represents risk, so standard deviation, and the vertical y-axis represents expected rate of return.
What emerges is an upward sloping line, moving from the bottom left to the top right. Let's walk the hierarchy of asset classes up this slope.
Okay, start at the bottom.
At the absolute bottom left, representing the lowest volatility and the lowest expected return, you find bank deposits.
Safe, but low yield.
Right. Moving up the curve, accepting slightly more interest rate risk for a marginally better yield, you find short-term debt instruments.
And as we keep climbing, we hit long-term bonds. They carry significant duration risk and purchasing power risk, so the expected return must be higher.
Exactly.
Higher still, we transition from debt to equities. Now we are absorbing the full brunt of business risk, financial leverage risk, and broad market risk. The standard deviation widens dramatically, so the expected return must be significantly higher to attract institutional capital.
And at the very peak of the curve, the extreme top right, we find derivatives, options, futures, leveraged instruments. They offer the highest potential expected returns in the market precisely because they carry explosive asymmetrical risk profiles.
There are a few essential glossary terms tied to this graph that are guaranteed to be multiple choice questions. Let's look at the y-axis, the expected return.
Okay.
Where does that upward sloping line actually originate? Does it start at zero return for zero risk, down at the 0, 0 axis?
It does not. It originates at a positive value on the y-axis known as the risk-free rate of return.
The risk-free rate.
Yes. The textbook notes that short-term government debt, like a 3-month treasury bill, is the standard proxy for this rate. The logic is that the government controls the printing press, so the probability of nominal default is absolute zero. They can always print money to pay you back.
Okay, I have to push back on that based entirely on our earlier conversation.
Oh, I know where this is going.
How can a treasury bill be considered truly risk-free when we just spent 10 minutes discussing how inflation destroys purchasing power? If inflation spikes to 8%, a 2% T-bill is guaranteed to lose real wealth. That sounds like a guaranteed risk.
It is a highly astute criticism, the one that trips up many finance students. When the textbook calls a T-bill risk-free, it is speaking strictly in nominal terms regarding default risk.
Just nominal default.
Yes. It is guaranteed to return the promised currency. You are absolutely correct that it carries profound purchasing power risk. However, in the architecture of the capital asset pricing model and basic risk-return trade-offs, we use the T-bill to represent the baseline time value of money.
Even with inflation risk.
Even then, because even if you take zero nominal risk, you demand a baseline return simply to compensate you for locking up your liquidity and deferring consumption today.
So the risk-free rate is our baseline. Any asset that sits further up the curve from that baseline carries what the text calls a risk premium.
The risk premium is the specific yield in excess of the risk-free rate that an investment is expected to generate. It is the literal, quantifiable compensation for tolerating volatility.
So if the T-bill yields 3%,
Right, if the 3-month T-bill yields 3% and a blue-chip stock is expected to return 10%, that's 7% difference. This is the ultimate operational metric for an investor. The required rate of return is the absolute minimum threshold of performance you demand to justify deploying your capital into that specific asset, given its unique standard deviation.
it's your hurdle rate.
Exactly. If your models indicate an asset will generate an expected return of 8%, but based on its massive volatility, your required rate of return is 11%, you reject the investment. It is not compensating you adequately for the fear you must endure.
The text makes one final crucial connection here. It states that this required rate of return serves as the discount rate.
Which brings the entire corporate finance syllabus full circle.
It really does.
When you are building a discounted cash flow model to value a company later in your MBA, the discount rate you use to pull all those future cash flows back to their present value is your required rate of return.
They're the same number.
Exactly. The higher the risk of the cash flows, the higher the discount rate. The higher the discount rate, the lower the present value of the asset. Risk directly dictates price. It is a mathematically impenetrable, elegant framework.
Let's do a final sweep of the battlefield. If you are sitting for this exam tomorrow, here is your conceptual checklist.
Get your pens ready.
First, you understand that total return is an uncompromisable combination of both periodic cash flow and capital price appreciation, measured exclusively against the original capital deployed.
Right. You know why dividing by the exit price is mathematically useless.
Second, you can articulate the purchasing power ratio to extract real returns from nominal illusions. Don't forget to add and subtract the one.
Yes.
Third, you can distinguish between systematic risk, the macroeconomic weather like interest rate hikes that no one escapes, and unsystematic risk, the microeconomic structural failures like excessive leverage or poor business strategy that can be diversified away.
You know the taxonomy.
Fourth, you grasp the philosophical intent behind variance, squaring deviations to aggressively penalize fat-tail outliers, and utilizing Bessel's N-1 correction to conservatively adjust for small historical samples.
But not for expected probability distributions.
Exactly. And finally, you can navigate the trade-off curve. You understand that the risk-free rate plus the volatility-induced risk premium dictates the required rate of return, which in turn acts as the discount rate to price the entire market.
If you possess that level of conceptual clarity, the mathematical formulas will simply become tools to express what you already logically understand. You are not just memorizing the textbook anymore. You are thinking like an institutional capital allocator. You are fully equipped to crush this module.
You absolutely are. But before we close the book on Unit 6, I want to leave you with one final thought, something to mull over when you finally graduate. Step away from the academic models and begin deploying capital in live markets.
Reality is a bit different than the textbook.
Just a bit. We just spent an hour breaking down the elegant, rational math of the risk-return trade-off. It assumes an ecosystem populated by perfectly rational actors who calculate standard deviations, demand exact risk premiums, and price assets flawlessly along a perfectly straight, upward-sloping curve.
The rational market theory.
Yes. But live markets are not populated by algorithms. They are populated by human beings. And human behavioral finance often makes an absolute mockery of variance formulas.
Oh, absolutely.
When a true systemic black swan event hits, when real panic takes hold, investors do not sit at their desks calmly calculating Bessel's correction.
No, they do.
They liquidate everything, regardless of the asset's intrinsic value or expected return. Risk premiums explode to infinity and rational pricing collapses entirely.
Fear takes over.
So as you master these textbook formulas to ace your exam, ask yourself this. When human emotion overrides mathematical logic, does the beautiful straight risk-return trade-off line hold its shape, or does it violently bend?
That is the real test.
And keep that in mind when you step into the real world. Good luck on the exam.